Why is Basel Accords Pillar 2 key to financial regulation? Have you ever wondered how banks ensure they are financially stable and can withstand economic shocks? One of the key elements in this process is Basel Accords Pillar 2. This pillar plays a vital role in financial regulation by introducing a supervisory review process that goes beyond the basic capital requirements set by Pillar 1. Pillar 2 ensures that banks do not just meet the minimum capital levels but also assess and hold capital against all material risks they face. This includes risks that are not fully captured by standardized models. Banks are required to conduct their own internal capital adequacy assessment process, which looks at various risks like credit risk, market risk, operational risk, and interest rate risk in their banking book. What makes Pillar 2 so important is that it gives supervisory authorities the power to evaluate and challenge a bank's internal risk assessments. This means that if a bank's capital is deemed insufficient, supervisors can step in and requiring the bank to maintain additional capital buffers. They can even impose restrictions on dividends or requiring the bank to raise more capital. This supervisory review acts as a safety net for the banking system, addressing risks that might be difficult to quantify or emerging risks that the first pillar's formulaic approach might miss. Historically, Pillar 2 was introduced to fix the shortcomings of the original Basel I framework. That framework applied a one-size-fits-all capital requirement that did not accurately reflect the risk profile of individual banks. By allowing supervisors to tailor capital requirements based on a bank's specific risk profile and local context, Pillar 2 aligns regulatory capital more closely with actual economic risks. Moreover, it encourages banks to improve their risk management practices, leading to a more resilient banking system. In practical terms, Pillar 2 helps prevent regulatory arbitrage, where banks might exploit gaps in fixed rules to minimize their capital. It promotes a dynamic approach to risk oversight, complementing the rules-based minimum capital standards of Pillar 1 and the market discipline of Pillar 3 through transparency. From a financial history perspective, Pillar 2 marks a shift in banking regulation from rigid, uniform rules to a more flexible, risk-sensitive system. This evolution reflects lessons learned from previous financial crises, where inadequate capital and poor risk management led to instability. It highlights the necessity of supervisory oversight that can respond to the diverse and changing risks present in the financial system. In summary, Basel Accords Pillar 2 is key to financial regulation because it ensures that banks not only meet minimum capital requirements but also actively manage their risks, fostering a safer and more stable financial environment.